We looked at the equity number on our banking app, $400,000, and started planning the renovation. Then the broker ran the real maths and the usable number was 200,000. Half of it gone before we'd even picked a tile. By the end of this video, you'll know your own real usable equity number and which of 4 ways to access it actually fits your household. We ran this exact maths against our own loan statement, the 80% ceiling, the Redraw balance, the bank stress test, before we let anyone near a kitchen catalog. We're going to work out both numbers, the app one and the real one, and since this is general information, not personal advice, your own figures deserve a licensed professional before anything gets signed. But there's a second gate after the equity maths that knocks back even asset-rich households, and almost nobody budgets for it. Here's the cleaner way to see it. Equity is not a pile of savings sitting in your house. It's borrowing capacity secured against the home, and lenders never let you borrow against all of it, no matter how the market has moved. That distinction sounds obvious in theory, but it's easy to forget once a big number is sitting right there on the screen. Picture a $1 million home with $600,000 owing. On paper, that's $400,000 in equity, the figure most banking apps happily show you. But most lenders cap new borrowing at around 80% of value, and that's what actually decides what you can touch, not the figure on the app. That 80% line exists to protect the lender if the market falls, not to punish you for having a valuable home. Borrow past it and you can trigger lender's mortgage insurance again, even if you paid it off years ago on the original loan. This is where the fine print matters. Just a bit more past that line isn't free, it's a fee most households don't budget for, and it can appear again even on a well-established loan. So of that $400,000 in paper equity, only about $200,000 is realistically usable. The other half stays locked behind that 80% line, no matter how good the property looks on the app. It's not just a big house problem. A $500,000 home with half of it owing follows the exact same maths. The usable slice still sits at roughly 80% of value minus the loan. In the first couple of years, most of a normal repayment goes toward interest rather than the loan balance. So the usable slice grows slowly at first even while the market news sounds exciting. That's normal, not a sign anything has gone wrong. Once you know your real usable number, there isn't one way to access it. There are 4 doors, 4 different jobs, not brand names, and one of them quietly costs disciplined households the most, which is exactly why banks love offering it. The first door is Redraw. It hands back extra repayments you already made ahead of schedule. It's not new debt, you're just getting your own overpayments back into your account on a loan you already qualified for. The catch is simple. If you've mostly paid the minimum, there's nothing extra sitting there to redraw, no matter how much the valuation has climbed since settlement. And if you're on a fixed rate, even genuine extra repayments can be restricted. Some fixed loans cap redraw entirely or charge a fee to access it before the term ends. The second door is a top-up, raising your existing loan with your current lender. Unlike redraw, this is genuinely new debt, assessed from scratch, not money you already paid ahead. Lenders recheck income, expenses, and often send a valuer back out. On a fixed loan, a top-up is usually harder. Some lenders won't lift the balance on a fixed rate at all. The third door is a line of credit, a revolving limit secured against the home. You draw what you need, repay it, and draw again. Interest usually only applies to what's actually drawn, which sounds like the friendliest door of all 4. That flexibility is genuinely useful for a staged renovation, where trades invoice in chunks instead of one lump sum, and you'd rather not borrow the whole amount up front. Here's the quieter cost. A line of credit that stays maxed out behaves like a permanent overdraft, and the rate is often less friendly than an ordinary home loan built for repayment, not revolving spend. A 2-income household drawing and repaying between pay cycles can manage a revolving limit comfortably. A single, variable income doing the same thing has far less room if a quiet month arrives. The fourth door is a refinance cash-out, replacing your whole loan with a bigger one at settlement, and often resetting the rate and structure at the same time. It's the most powerful door and the most involved one: full credit assessment, possible discharge and break costs, and a bigger loan you'll be living with for years, not months. Large cash-out amounts also tend to draw more scrutiny than a modest, well-explained request. If the honest goal is just a cheaper rate with a small cash need, a clean switch can beat inflating the whole loan simply because the equity happens to be sitting there. This decision looks different depending on where you're standing. Someone early in their loan may find redraw and usable equity are both thin, no matter how nice the market news sounds. The math simply hasn't had time to work in their favor yet. Someone on a fixed rate may find several of these doors are restricted until the fixed term ends, and that break costs can quietly erase the equity win they were chasing. If you're renting and still saving a deposit, this equity conversation isn't yours yet, but the same 80% line and the same stress test will apply to your very first loan too. So pause on this one. In your household, is the money already sitting there waiting in redraw, or would accessing it mean taking on genuinely new debt for the first time in years? If the purpose is investing rather than renovating, keeping that debt cleanly split matters for record keeping later, a job for an accountant, not a video. Mixing the two can cost more in confusion than it ever saves in convenience. Here's the part that catches even asset-rich households off guard. Usable equity is only the security ceiling. There's a second gate, and it has nothing to do with how much the house is worth. It's called serviceability, and regulators require banks to test it at your rate plus 3 percentage points, not the rate you'd actually pay. Every top-up, every line of credit limit, every cash-out refinance is assessed at that higher, stressed number. That means a bigger loan can genuinely fail this test even with plenty of equity behind it. Fat equity and strong income are two different questions, and the bank asks both. The house being valuable doesn't answer the second one. Since February this year, regulators have also been watching total debt against income across the whole lending book. Push total debt towards 6 times income, and appetite can tighten even when the property itself looks perfectly secure. That doesn't mean equity access is off the table for your household. It means we have equity and the bank will fund it are two different sentences, and only the second one matters on application day. Self-employed income usually needs a couple of years of tax returns to prove, not a single payslip, so build extra time into the plan if that's your household situation. One more quiet trap. The value on the app is usually an automated estimate, not a lender's valuation. The bank's own valuer decides the real ceiling, and it can land lower than the app ever suggested, which quietly shrinks the usable number again. It isn't always bad news, though. If genuine improvements have been made or the local market has strengthened, a formal valuation can also lift the ceiling, which is exactly why it's worth asking for one rather than trusting the app's guess either way. Let's put real numbers on it. Picture a household with a $1 million home and $600,000 owing, $400,000 paper equity, $200,000 usable, wanting $80,000 for a renovation with fixed quotes in hand. If $90,000 is genuinely sitting in redraw already, that's the fastest path, assuming the fees and minimum redraw rules on the loan actually allow it. A top-up for $80,000 fits comfortably within the usable ceiling, repayments rise, and the stress-tested buffer still applies. A line of credit with a $100,000 limit also fits, useful if trades invoice in stages. Refinancing with an $80,000 cash out also clears the ceiling, but only genuinely wins if the new rate and fees beat simply keeping the current loan and choosing one of the other 3 doors instead. All 4 can technically deliver the same $80,000. What changes is what you already have available, what new debt you're willing to take on, and how disciplined you'll be once the money lands in the account. Honestly, what surprised us in Friends Equity conversations was how often the chat started at the app's big number and never once reached the repayment line. It's an easy thing to skip. We nearly skipped it too, and we'd already read half the articles on this. The habit that helped most was simple. Check the loan statement once a quarter, not just when a renovation idea shows up. The usable number stays real instead of guessed. What we do differently: open the loan statement first to check what's already in redraw, then work out the 80% usable number, then ask for a stressed repayment quote in that order before collecting a single tile sample. Honest counterpoint: sometimes the win is not accessing equity at all. If the renovation is optional and the buffer already feels tight, staying cash poor for another year can be less stressful than a permanently larger mortgage you'll be carrying long after the kitchen is finished. One more honest warning: If values have dipped since your last valuation, a cash-out refinance can push you back over that 80% line without anyone changing a single spending habit. Worth checking before you commit to a purpose you can't easily undo. If you're older and want income without new repayments, a standard top-up usually isn't the right tool at all. Reverse mortgages and the government's home equity access scheme are a different product family, with their own age, fee, and compounding rules. Start with Money Smart and Services Australia, then get advice specific to your situation before signing anything. Wherever you are in Australia, capital city or regional town, the same two gates apply. The 80% usable equity ceiling and the stress-tested serviceability test behind it. Only the property values change, not the rules, and not the order you should check them in. It's also worth comparing your own lender's offer against one broader broker conversation. The extra hour can reveal a cheaper structure for the exact same usable equity without changing anything about the plan itself. Here's the everyday version of everything we just covered, small enough to do in one sitting tonight. Write the purpose and the dollar cap in one sentence. Kitchen and bathroom, 80,000, fixed quotes, attached beats, options every time a lender asks. Then calculate your usable equity at 80%. Check your redraw and offset balances, confirm whether you're fixed, get a stress serviceability estimate, compare the three main paths on one page, price the fees, and decide the repayment plan before the money even lands. None of this needs solving tonight. You only need the next honest number, the usable one, not the one on the app, and 1 hour is genuinely enough to find it. Going direct to your own bank is often the fastest of the four doors. A broker earns its extra step when you're genuinely comparing lenders, not just topping up the one you already have. The goal was never to make the equity number smaller. It was to make it real, so the renovation, the investment, or the next big decision gets built on the number the bank will actually approve, not the one sitting on a screen. If this helped map your thinking, subscribe. We put out one of these guides every week.